Hey there, good morning everybody. It's Bill Provost with Franklin Loan Center. And last week I mentioned a handful of literally undeniable signs of strength in the economy, and particularly in real estate. And as I mentioned last week, let's just in the spirit of being very realistic, let's talk about a couple of things that we should watch out for that could be signs of the economy. Maybe, that could be signs that could show that the economy is maybe weakening a bit, and could start leading towards like a recession or whatever it might be. Here's what's crazy is that we all have to understand, like, things don't run up forever. We are definitely in the longest economic expansion that the U.S. has ever seen. We're well over 10 years now. Which is, it can't continue to run forever. I think the main thing that I want to point out is like, look, the economy, I can promise you our economy is going to see another recession at some point. What none of us totally understand is when this will happen. Obviously we can't, none of us has that crystal ball. One thing that I feel really strongly about is that unlike the last downturn that came about, I think one thing that's really different about this one is, and I think most experts agree on this, is that it will not be led by real estate. I think last time the reason our economy buckled is because there was just insanity going on in real estate lending in particular, which was creating unrealistic bubbles and prices and everything else. And it just became burningly obvious that everything was going to collapse. It was a house of cards. This time things are so very, very different along those lines. But let's do, and again, this is right out of Walter Neal's presentation from now a couple of weeks ago. And I think they're really noteworthy. I think there's two main things that I've seen, that I've seen mentioned a bunch of different times by different economists and things like this. And Walter brought them up again, a couple of weeks at his presentation here in Temecula. The first one is, and this one gets a little geeky, but an inverted yield curve. So what the heck does that mean, right? And particularly what we're watching is the treasuries, the 2-year treasury versus the 10-year treasury. So what you would expect. So what that means is you're making a decision to invest for either 2 years, invest your money for either 2 years or 10 years. So it stands to reason that you would get a higher interest rate or a higher yield if you tie up your money for 10 years than if you tie it up for 2 years. So one thing to watch for, and there's a bunch of economists that keep an eye on this, is if that yield for the 2 year actually exceeds the 10-year yield, then that shows a sign of weakness. It shows people like, look, you can't tie up my money for 10 years. Let's just, and it becomes a sign of weakness in the economy. The yield curve inverted here several months ago, and actually recently inverted again literally as recently as yesterday. This is just definitely one of those things to kind of keep an eye on. It's not a definitive, sort of like, oh my gosh, we're definitely going into recession. There's a lot of stuff going on in the short end of the yield curve right now that are really bringing they're sort of, for a while they were trying to artificially bring it down. So anyway, watch that inversion of the 2s and 10s. The other thing, and this one is actually a pretty spot-on predictor, and that is like literally without varying from it. It's happened 100% of the time. After a trough in the unemployment rate, like literally 100% of the time we've hit a trough. Within a year, the economy has headed into a recession, right? We're at a very low spot in the unemployment rate right now. We've been at 3.5% for the last couple of months. We don't know, the crazy thing is right now today, we don't know, are we at a trough? Could we go lower? Are we going to stay where we are? Whatever it might be. But if you look at a chart, and I can put that up for everybody into the comments below, but if you look at a chart from the trough, and that trough could be anywhere. I mean, it could be, maybe the trough was 4% or 5%. Right now, again, we're at 3.5%. From that trough, if it starts creeping up, and Walter said, if you start to see that thing get to 4%, that is also could be a predictor of a slowdown in the economy coming. So just a couple of things that I want to throw out there. Like I said before, one thing that I love about where we are is the real estate market actually is one of the real strong parts of our economy right now. Inventories are still very, very low, like really, really low nationally, and also locally here in Southern California. It's a real challenge. And so there's a lot to feel really good about, but I think there's a couple of things in the economy to keep an eye on. This could very well be, they say 3 out of the last 5 recessions here in the U.S., housing prices actually went up. That's a lot of times driven by what continues to be low interest rates and things like that. So this is not a, oh my gosh, the sky is falling kind of thing. It's just a couple of things to watch out for that could have an impact on the greater economy. But even through that, all the experts that I'm seeing are actually expecting real estate to stay strong. So that's what I have for you this week. Sorry for getting a little geeky, and I'll see you all next week.